Have you ever walked into a store and felt overwhelmed by the sheer volume of products on the shelves? Or maybe you've been frustrated when you couldn't find what you were looking for because it was out of stock. These experiences point to a crucial aspect of business, inventory turnover. Now, you might be wondering, what exactly is inventory turnover and why should you care? Well, let's dive into it. Inventory turnover is a financial metric that measures how many times a business sells and replaces its inventory over a specific period. Think of it as a rhythm that tells you how quickly a business can sell its products and restock them. The formula is pretty straightforward. Inventory turnover equals the cost of goods sold divided by the average inventory. So, if a business has a cost of goods sold, or COGS, of $1,000,000 and an average inventory of $200,000, the inventory turnover ratio would be 5. This means the business sold and replaced its inventory 5 times in that period. Pretty simple, right? Now, let's consider the implications of a high inventory turnover ratio. Imagine you own a clothing store. Throughout the year, your COGS is $500,000 and your average inventory is $100,000, giving you an inventory turnover ratio of 5. But what if you implement some smarter inventory management practices and boost that ratio to 7? Suddenly, you're selling and replacing your inventory 7 times a year instead of 5. What does that mean for your financial statements? Let's break it down. First, on your income statement, a higher inventory turnover can lead to a lower COGS. If your COGS drops to $350,000 because you're managing your inventory better, your gross profit jumps to $150,000. That's a significant boost to your net income and overall financial performance. Next, take a look at your balance sheet. With that increased turnover, your inventory levels would drop to $70,000. Less inventory means reduced working capital requirements, which can free up cash for other initiatives, like marketing or expanding your product line. And let's not forget about cash flow. The higher turnover means less cash tied up in inventory, allowing you to invest in new products or even expand your business. In short, higher inventory turnover can lead to improved gross profit, reduced working capital, and enhanced cash flow. Sounds great, doesn't it? But what happens when the tables turn and you have a low inventory turnover? Let's say you're running an electronics store. Your COGS is $1,000,000 and your average inventory is $300,000, giving you a turnover ratio of 3.33. Now, let's say demand declines and your turnover drops to 2. You're now only selling and replacing your inventory twice a year. This situation can wreak havoc on your financial statements. On your income statement, a lower turnover ratio can lead to a higher COGS. If your COGS skyrockets to $1,500,000, your gross profit plummets to $500,000. That's a hit to your net income and overall financial health. On your balance sheet, a low turnover means higher inventory levels. If your inventory balance climbs to $400,000, that increases your working capital requirements, which can squeeze your cash flow and limit your ability to invest in growth. So, what's the takeaway? Understanding inventory turnover is essential for managing inventory levels effectively. A high turnover ratio is generally a good sign, indicating that a business is selling inventory quickly and efficiently. It reflects effective inventory management and minimizes the risk of excess stock. Conversely, a low turnover ratio may signal that a business is struggling to sell its product, leading to increased holding costs and potential obsolescence. Now, you might be wondering, should organizations aim for higher or lower inventory turnover? The answer is a resounding higher. The higher inventory turnover ratio indicates effective inventory management and quick sales, which can improve cash flow, reduce holding costs, and enhance overall efficiency. But let's not gloss over the challenges. There are some common accounting watchouts when it comes to inventory turnover. For instance, inaccurate calculations of COGS can skew your turnover ratio. Seasonal fluctuations in sales can also affect your numbers. If your business is in an industry where demand varies significantly throughout the year, it can be tricky to compare turnover ratios across different periods. Additionally, if your industry benchmarks don't align with your specific business type, that can lead to misleading conclusions. Excess or obsolete inventory can further distort your turnover ratio, making it look like you're not moving products when, in fact, you might just be holding onto outdated stock. So, how can cost accountants help? They play a crucial role in monitoring and improving inventory turnover by conducting regular analyses to identify trends and potential issues. They can pinpoint the causes of low turnover and recommend improvements, whether that means reducing excess inventory or streamlining production processes. Cost accountants also keep a close eye on COGS to ensure accuracy, identify opportunities to cut costs associated with inventory, and help implement inventory management systems. These systems can track inventory levels, forecast demand, and optimize production processes, all of which contribute to better inventory turnover. Accountants have a variety of tools and processes at their disposal to monitor inventory turnover effectively. Inventory management systems can provide real-time visibility into stock levels, while financial reporting helps track trends over time. Sales forecasting can predict future demand and align inventory levels accordingly, while supply chain optimization ensures that inventory is delivered on time and in the right quantities. Regular inventory audits can also help maintain accurate inventory levels, preventing excess stock or stockouts. In conclusion, understanding inventory turnover is vital for any business owner or manager. It's not just a number, it's a key performance indicator that can significantly impact a company's financial success. By accurately calculating and analyzing inventory turnover ratios, businesses can gauge how quickly their inventory is selling and make informed decisions about purchasing and production. Improving inventory turnover can lead to a more efficient and profitable operation. So, whether you're a seasoned business owner or just starting, keep a close eye on your inventory turnover. It could be the difference between thriving and merely surviving in today's competitive marketplace. Thank you for tuning in, and remember, managing your inventory wisely can pave the way for your business's success.